Welcome to The Explainer. So today we're looking at a scenario that is literally keeping global economists awake at night. We're examining the very bedrock of global finance and the growing evidence that this foundation is, well, it's starting to crack. We're talking about the U.S. Treasury market, an institution so absolutely critical that its stability dictates the financial security of pretty much everyone on the planet. To really wrap our heads around the scale of what we're dealing with here, just think about this number. $32 trillion. That's the current size of the U.S. Treasury market. It is the undisputed colossus of the global financial system, just vastly bigger than any other market for sovereign debt on Earth. I love this quote because it hits the nail right on the head. Treasury market prices are to investors like water to a fish. This market is the invisible, essential environment that allows all other global financial operations to survive and function. It's the baseline for pricing risk everywhere. Without it, the entire ecosystem is gasping for air. All right, Section 1, the ultimate safe asset. Let's quickly trace how we actually got from Alexander Hamilton's original 6% bonds back in 1790 to this modern $32 trillion titan.
Hamilton's grand vision for American debt basically boils down to one modern financial concept: liquidity. This is the holy grail of finance, right? It means an investor can buy or sell an asset safely, cheaply, and instantly. Traditionally, no market on Earth promised more liquidity than the U.S. Treasury market. It was considered the ultimate, rock-solid safe asset. But then, early 2020 rolls around, and the unsinkable happens. As the pandemic triggered a global panic, companies and governments everywhere rushed for immediate cash. Naturally, they tried to sell their safest, most liquid assets, U.S. Treasuries. But the market just froze. Big banks, usually the guys acting as intermediaries, couldn't handle the massive wave of selling. The ultimate safe assets suddenly became incredibly hard to sell, forcing the Federal Reserve to step in and buy up trillions in debt just to stop a total collapse. This was our first major warning sign. Which brings us to Section 2. Dependable buyers are vanishing. Let's dive right into this, because that 2020 panic exposed a deeper, much quieter shift happening behind the scenes. The most reliable buyers of U.S. debt are quietly disappearing.
Now, what's really fascinating here is the dramatic shift in ownership. For decades, foreign central banks were guaranteed buyers, a tradition dating all the way back to a 1974 deal with Saudi Arabia. But today, they hold just 13% of treasuries. That's their lowest share in 30 years. And they've officially been surpassed by private commercial investors, who sit at 17%. So, you might be wondering, why are foreign governments stepping back? Well, it really comes down to geopolitics and simple math. First, after seeing Russian central bank assets frozen following the invasion of Ukraine, other nations fear the potential weaponization of the dollar. Second, central banks are diversifying. They're buying up record amounts of gold and other currencies instead. And finally, there's just a massive scale mismatch. U.S. federal debt has grown by $17 trillion in a single decade, vastly outpacing the growth of global foreign exchange reserves. There just isn't enough foreign reserve money to keep buying up all this debt.
Moving on to Section 3. Enter the hedge funds. With heavily regulated dealer banks and cautious foreign governments backing away, someone still has to buy this absolute mountain of debt. Enter our risky new replacements.
We're witnessing a monumental shift here, from staid, conservative central banks to private hedge funds. Think about the stark contrast. Central banks bought treasuries for absolute security and to defend their own currencies. They were completely dependable. Hedge funds, on the other hand, they are highly leveraged, capricious, and strictly chase returns. They don't care about global stability. They just care about profit. This whole dynamic feeds perfectly into a highly popular strategy called the basis trade. Let me walk you through it. Hedge funds look for these microscopic differences between the price of a treasury future and the actual treasury bond. Step 1, they sell the futures contract. Step 2, they borrow massive amounts of cash. Step 3, they use that cash to buy the underlying treasury bond for fractionally less. And step 4, when the contract matures, they pocket that tiny, seemingly risk-free price difference. All right, Section 4, a risky new reality. Now, because the profit on each of those basis trades is so microscopic, hedge funds have to use extreme leverage, borrowing truly astronomical sums of money just to make it worthwhile. And that introduces incredible dangers to the global financial system.
And this quote brilliantly illustrates the sheer peril of this situation. As one Harvard researcher noted, the basis trade is literally like picking up pennies in front of a steamroller. Sure, those pennies grow nicely with leverage, but if the Treasury market experiences a sudden drop, lenders will demand their money back immediately. This would force these highly leveraged funds to aggressively liquidate their assets, which could crush the market entirely. Steamroller risk indeed. To really put this tight margin into perspective, let's look at the data from the Office of Financial Research. For every $26 hedge funds invest in these relative value trades, $25 is borrowed. That means the margin for error is essentially zero. If the value of the bond falls even slightly, that tiny buffer is entirely wiped out, triggering a dangerous chain reaction of forced selling. But the risk isn't just coming from the buyers, it's coming from the sellers too. Right now, U.S. policymakers are looking to issue way more short-term debt, known as bills, to try and lower the government's immediate interest payments. But funding long-term debt with short-term bills creates massive rollover risk. If interest rates suddenly spike, the government is instantly exposed to gigantic, crippling payment increases.
Section 5. Are there any alternatives? If the Treasury market is losing its safe haven status, you've got to wonder, is there anywhere else for the world's money to actually hide? Well, when you actually look at the numbers, the U.S. Treasury market absolutely dwarfs its closest competitors. While America has $32 trillion in debt acting as a safe asset, all 9 of the remaining AAA-rated nations combined offer less than $7 trillion. And that heavily hyped crypto stablecoin market? Yeah, it sits at just a fraction of a single trillion. Basically, every supposed savior out there completely fails to match the scale and utility of American debt. The Eurozone's shared debt, it's too small and lacks true political unity. Gold might be a safe harbor, but it offers absolutely zero interest yield. Deregulating banks won't work because their balance sheets literally cannot absorb a market that has surged 380% since 2008. And China's strict capital controls mean foreign money could easily get trapped there during a crisis. Bottom line, these alternatives are just an illusion. Which leads us to Section 6, a world without safety. This brings us to the climax of our explainer. We've seen how the market is shifting from reliable central banks to volatile hedge funds and how the alternatives fall drastically short. So what does this all mean for our daily lives? It all really comes back to this foundational financial concept called the Sharpe ratio. This formula uses the pure interest rate of a riskless asset to price the risk of literally everything else. Treasuries have always been that riskless asset. If Treasuries are no longer safe, the fundamental math used to price every corporate bond, stock, and loan simply crumbles. All global investments become dangerously unpredictable. So the absolutely crucial point here is how this directly impacts you and me. Without that safe anchor, investors are going to demand higher returns for taking on risk. That means spiking 30-year mortgage rates for homeowners. It means crippling interest payments for the government, literally taking money away from public services. It means a massive global supply shock as banks lend less money for new business projects. And it leaves the entire global economy highly vulnerable to unpredictable political maneuvers. We're essentially staring down a future where the financial system flies without a safety net. The era of the undisputed, perfectly liquid U.S. Treasury bond is fading, and it's being replaced by volatile actors and fragile borrowing schemes. Which leaves us with one seriously haunting question. If the ultimate safe haven is no longer safe, where does the world's money hide? Thank you so much for joining us for this explainer, and I'll catch you next time as we continue to unpack the forces shaping our world.